Hey guys, this is Izzy. If you have liked and subscribed, thank you for coming back. And if you haven't yet, like and subscribe to support my channel so I can keep on creating more content for you. So today I'm going to teach you guys about fair value gaps. I'm going to teach you what they are and how to pick the correct one because we use these a lot, especially with the 2022 mentorship. And it took me a long time to finally understand which ones to pick because that's what a big question that I get from people. They know what they look like, but if you go on the smaller time frame, like the 1 minute, it's really hard to focus and know which one to pick. And a lot of people do use indicators to help them figure out, like, what do they look like. And I do like some indicators, but I also do not like most of them because they will mark like 10 or 20 fair value gaps, and then you get just as confused rather than just marking your own. So I will show a way to like change your indicator that it doesn't look that crazy, but I'll also show you how to identify them, or how I identify them, or the correct ones. So fair value gaps are formed by 3 candles, leaving an imbalance or an inefficiency in price that needs to be filled. And it happens when the market is one-sided and leaves liquidity voids on the lower time frame. That being that we are trading on the 1, 2, 3, 4, and 5 minutes, that's when I'm mainly looking for them for entries. I tend to use the 1 hour, 4 hour, and the daily as either targets or areas of interest for price to start creating another set of fair value gaps on the smaller time frame, so you can combine them. So price is likely to come back and fill these imbalances in order to rebalance itself. That meaning whenever we have price push towards one side, you create an inefficiency in price, meaning we kind of leave I don't want to say a gap, but a void. And price does need to come back to at least 50% of that void to fill in and rebalance itself in order to move forward. So like I said, they can be used as entry or as targets, as an anticipation of where price will present either a buy side or a sell side inefficiency. So on the left side, we have an example. So it would be the top of this candle and the lower of this, and it creates this gap. So this is a bullish fair value gap. And on the right side, we have all these bullish candles, and then you see a big bearish candle with another bearish candle formed. And as you can see, the low of this candle and the high of this form a bearish fair value gap. And I'm going to share with you my screen so we can go into some examples on the chart. I'm going to start by showing you guys the daily fair value gap. As you can see, we have the high of this candle and a low of this, and we form an inefficiency in price, and we leave this. As ICT say, you want to think about a paint roller. Like whenever you're painting, the way the price works, you want to go up and down. Once we fail to go down and fill this void, it creates a gap. And as you can see over here, we have many gaps. However, whenever we start to go down, we start filling them like little by little. And the end of these gaps are where we're interested in seeing. Once price touched the end of this one, and you can see we did use this as to change the state of delivery. With the daily fair value gaps, what you do want to do is mark the 50%, because those are bigger fair value gaps. So you want to make sure that at least 50% of the gap is filled. We do not need to fill more than 50%, but we can. So once I mark my daily fair value gap, as you can see, we have a bearish one over here as well. But you can go to the lower time frame, like the 4-hour. This is where I refine them. So as you see over here, we have this inefficiency in price as well. Right, so on the daily, this was a bearish fair value gap that formed. We can do the same exact thing that we did with the previous one, like the bullish one. We can do the bearish one and mark 50%. And then I just delete my fib. So it goes to the 4-hour, and within the 4-hour, I try to see where, like, and maybe refine it, right? So like right here, like there is a fair value gap right here, but I know this is the 50% of the daily. And then again, the way that they work, the higher the time frame, the stronger they will be. So I am inclined to think that the 50% of the daily is going to be a lot stronger than the 4-hour, but it's still an area of interest. Then we go to the 1-hour and we look for fair value gaps. This one, for instance, I don't have it marked, but we can mark it right now. And we can call this a bearish fair value gap. As you can see, price touched it and filled completely this area so many times and sold from it and almost touched here. So this is an area where price finds inefficiency and sells from. In order for us to see a change of character or a market structure shift, we would like to see a break and a close above the bearish fair value gap. Then that changes the state of delivery and the order flow of the market. And then we start creating bullish fair value gaps, as you can see on the right hand side. And now we're leaving voids towards the upside. So now we anticipate that, for instance, let's just say if we touch the 50% of the daily fair value gap, we can come back to this 1-hour bullish fair value gap. So now we're anticipating that price is going to touch, fill at least 50% of this, in order to move forward. So once price has touched at least 50%, we can anticipate this buy towards the upside. And now we look for the fair value gap that is above that, and the liquidity targeted above that. So we can target this fair value gap. I think this was at 15 minutes. Or maybe 1 minute. Yep, a 1 minute fair value gap that got left behind. We can anticipate price to touch here, bounce towards the very next fair value gap, create a new bullish fair value gap, probably somewhere around here. Fill 50% and continue to find liquidity towards an external buy side and possibly touch the very next fair value gap up top that I have marked right there on top of the external buy side liquidity. So this is how you look for the order flow. And then, you know, price is going to create another bullish fair value gap, and you just use this area as pivot points. And if you have not watched my other video about liquidity, I would suggest that you do so, because now I'm going to explain to you how you pick them. Because yes, you see that you can create all of those and mark them, but how do you know which ones is price going to respect? And I'm going to give you an example from this morning, as it's fresh in everybody's mind. And I'm going to turn on my sessions highs and lows indicator. So in order for you to understand which ones I'm going to pick, you need to watch the liquidity video. So if we're going to presume the London high is an internal buy side liquidity, and that our low of the day and high of the day, let's just say we're at 8 o'clock this morning, well, 8:30 this morning. Let's just say we're looking for an entry at 9:30, okay? And then we mark the 50%, which is our equilibrium area. We are going to assume that price took sell side liquidity at the London low. And now it's seeking buy side liquidity, which it took exactly at 8:30. Now we are looking, let me run it back a little. So we're not looking at 9:30, we're looking before 9:30. We know this is our equilibrium. We know we just took buy side liquidity. Once we take like buy side liquidity, we're looking for price to reverse. And why is price going to reverse? Because we need to fill at least 50% of this. And which one was the fair value gap closest to equilibrium? This one right here. So now I'm looking for price to come and tap into it. Once price comes and taps into it, it starts to trade above equilibrium. And with this at 847, we create another inefficiency in price, and we leave a very evident bullish fair value gap as well. Once we touch internal buy side liquidity again, just the area that we knew that buy side was, you see we start to come back to this fair value gap. Then again, you always want to see price do a 50% at least pull. So you can align these fair value gaps with the 50%, and that usually works. And you want to combine them with buy side and sell side liquidity. So after price is done taking one of these sides, you want to see price start to create fair value gaps, and you can build up your positions from there. So you can use this one too. And exactly at 9:30, we come back trading to the first one. You could have gotten on the second one as well. So it's not that it's completely wrong, but you want to pick the first one that got created after taking liquidity. So we took liquidity, expanded towards the downside, below equilibrium, because you want to buy below equilibrium, want to buy in discount area. And you can measure with your fib as well, which was around, then again, around 50%. And whenever we start to create new bullish fair value gaps, you can start building up your position. So at 9:30, when we bought and then bounced back, we already had created the newest bullish fair value gap, which I was looking into trading to this. You don't want price to come back towards the very first one, because then you're creating a market structure shift, and you don't want that. The only market structure shift you want when you're in a bullish order flow is towards the upside. So you can start using these as little step stools, almost like going up the stairs. You don't want to step down before you step up. You want to continue to keep on climbing and stepping up. So the same thing with these and these. And then I was targeting, like I said, not just the 50% of the fair value gap, but all these external buy side liquidity points. So you would mark your buy side liquidity as previous highs and wait for price to take one by one by one. And you can combine them with sessions highs and lows. So to assume that this was an area of liquidity, because we have double tops, like it looks like a liquidity pool, and we also have a fair value gap right here. So we are to assume that every time we take an external buy side liquidity, we're going to continue to climb until we find possibly a higher time frame fair value gap, and we're going to fill it at least 50%, and you can look for a reversal. So to assume that the 50% was right here, you could have set a pending order for a sell. Put your 50 point stop. For 100 points, take profit at least. And your trade would have hit. However, like I said, we are only interested on the fair value gap after we take liquidity. We need to take all this external sell side liquidity in order to pick the right fair value gap. So I hope this helped, and I hope you guys enjoyed. If you have any more questions, please let me know in the comments. And thank you for watching, and please let me know if there's anything else you want me to go over that it might not be as clear. And don't forget to like and subscribe for more.